2024 has been a great year to be invested in the stock market. Many countries around the world have had great returns, but the US is one of the most popular places to invest for Canadians and people around the world. For Canadians investing in the US market, you could buy individual stocks yourself, or you could use something like a mutual fund or an ETF to get access to a whole bunch of US stocks all together in a single ticket investment. There are all sorts of different ETFs that invest in US stocks, and not all of them track an index like the S&P 500 or the NASDAQ. It's a common misconception that many people have that ETF means index fund. And while I am an advocate for index investing, there are so many other options available that you might have heard of before. I thought it would be really interesting to see which one performed the best here in 2024 in a year where US stocks perform particularly well. So in this video, I'm going to break down which Canadian listed US equity ETF performed the best this year, what made it perform that way, how much does it cost, and how to know whether a fund like this has a place in your portfolio. All right, if you're with me so far, I need to go through a quick disclaimer because I am an investment advisor. However, I'm probably not your investment advisor. And a top performing ETF in the past, it's not a guarantee of success in the future or even a suggestion of success in the future. You can lose money investing with ETFs, even though they are broadly diversified in some cases. And even equity ETFs or buying stocks is not for everybody and not for everybody's risk tolerance. Your personal circumstance, your financial situation, your knowledge, your timeline, and your objectives should determine how you invest, not what anybody says on a YouTube video, including this one. So this video is not a recommendation to buy this ETF or any other ETF. It is simply just a breakdown of what this fund is and how to understand metrics around investing. Finally, this one is just from the US equity category. So before you link some additional ETFs that might have performed better than it, some leveraged Bitcoin ETF or some garbage like that, this one is just looking at the broad US equity category and the fund that performed best in that category. So there's likely other ETFs that perform better, but since so many of you are interested in investing in US stocks, I thought it'd be interesting to start here. If you have ideas for other things that you'd like me to cover, maybe even the worst ETF of this year, put it down in the comments below and maybe we can do another video on that topic. All right, now that that's out of the way, let's get right into it. The top performing US equity ETF here in Canada for 2024 is, drumroll please, FCMO. This is Fidelity's US Momentum ETF. Okay, so this is the Fidelity US Momentum ETF, and it is the top performing US equity ETF as found on Morningstar. Today is December 9th, 2024. So if you're looking at this at a different time or even right at the end of the year, the performance here might actually look a little bit different. But right close to the end of the year here, this one has performed very, very well and is currently top of the category. So as far as performance goes, we are seeing 61.12% year to date. And that is in contrast to the index, which is the US total market in Canadian dollars, which is up 38.41%. So this one has performed really, really well. But now you might be asking, what is the momentum part of this ETF name? Momentum is a factor and a rule-based system for picking stocks to include in a portfolio. And there are many different factors that can be included in a portfolio. Value is a really common one. Size is a different one. So that's small cap or large cap stocks. Momentum is one factor that Fidelity has chosen to build out as a product. And they use a 12-month price return momentum. So this isn't a day trading strategy. What they're doing is they're evaluating stocks that have positive performance. And I'm sure it's a bit more proprietary than this, but essentially that have a 12-month momentum. And they bundle those into the ETF and try to outperform as a result. Now, if we go back to how it has performed relative to the index, in certain years, it definitely will not outperform, and they know that. And that's kind of how factor investing often works. Sometimes it's great, sometimes it's not great. And so if we go back to Fidelity's page here, it says that a momentum factor-based strategy is an efficient complement to a well-diversified portfolio. This is a complement to a well-diversified portfolio. So even the fund company themselves is not saying this is the only thing that you should have in your portfolio. This can be a part of your portfolio. So like I said before, there are many factors that academics have been able to isolate when it comes to investing in the stock market, and momentum is just one of those factors. So this ETF only looks at one factor. It only looks at one country, the US in this case, and it is listed in Canadian dollars, which impacts the performance, especially when the Canadian dollar has done so poorly relative to the US dollar, because it's invested in US stocks with Canadian dollars. If the Canadian dollar decreases in value, the performance of this fund will increase accordingly along with it. So that's a brief overview here so far, and let's get into the cost of this fund. So now if we're looking here, we can see that the MER is 0.37, which isn't really that bad for a bit more of an active strategy. A pure index, what some would call a passive strategy, would probably be closer to 0.1% or something like that. So this is a little bit more expensive, but for traditional active management, this is still considerably cheaper than that. So this is kind of finding that gap between pure active and passive. It's a little bit more active, it's a little bit more expensive, but you're getting something different than the index. So now, did this ETF actually do what it was advertised to do? Does it actually track the momentum factor? Well, what you can do on Morningstar is you can go over to the portfolio tab, and then you can scroll down to where it shows the factor profile. And here you can see that we're looking for the momentum factor in particular. If it is truly tracking the momentum factor as Morningstar defines it, you would expect this big blue dot to be very close to the high section of the momentum factor, right? So these are some of the other ones that I talked about before. This is style, so that's growth versus value. You could look at size, large versus small, things like that. But this one is primarily concerned with momentum. So what we don't want to see is a huge range within the momentum factor here itself. This is pretty tight, close to the top of the high momentum categorization. So yes, it is largely doing what is advertised that it's going to do. What you don't want is to buy a momentum ETF and have it perform like a low momentum ETF. And that way you don't actually know what's going on in your portfolio. So this is something that you can take a look at when you're looking at factor ETFs or mutual funds. You can go over here to this factor profile on Morningstar to see if it's actually doing what it says it will. Now, getting into some of the risk metrics with this ETF, it hasn't been around for that long, so I'm going to look at the 3-year numbers here because it doesn't have a full 5-year track record yet. And so just in the last 3 years, which isn't a great evaluation period, but that's all that we have right here, we can take a look at a few different things. Standard deviation is a metric that you can use to show how bouncy something is over any given period of time. So the higher the standard deviation, the more volatile it is from day to day. Some people call that risk. There's a variety of different ways to define risk, but this is just volatility and price volatility in particular. And so if we look at the index, over that period of time, it was a little over 14%, whereas this ETF has been closer to 16. So that is going to be a little bit more of a bumpy ride. And that would just kind of make sense based on the factor that this is trying to track. Another one that you can take a look at to see how different it is compared to the index, right? If you're going to buy a fund that is different than an index fund, you want it to be different, probably. You don't want it to just track the index minus a higher fee. And so one way you can take a look at that is this R-squared figure. What R-squared does is it takes a look at the performance and it tries to explain the performance compared to the index. So the index here is, let's call this 100%. Essentially, all the performance of the index is attributable to the performance of the index. Okay, that's kind of confusing. But the investment itself here, only 82% of the performance can be attributable to the underlying performance of the index, which means that there is about 17%-ish that is attributable to something other than just index performance. And so in this case, that would be the factor exposure in particular. So it's not going to differ wildly from the US equity index, but there is a little bit of a difference there. Now, if we take a look over here at the maximum drawdown, that means from peak to trough at any given point, how much was it down? And over here, we can see how long that lasted. So during 2022, pretty much everything was down across the board, and this fund was no exception. So starting in January, all the way until June 30th, so that was a 6-month drawdown, it was down almost a full 23%, and that was more than the index. So if you are taking a look at some of the things that we've talked about here already, standard deviation is higher than the index, maximum drawdown has been lower than the index, and it's different than the index. This is not something that would lead me to believe that would have any sort of what we call downside protection. This is not a defensive strategy by any means. This would be adding a little bit of hot sauce to the portfolio. Okay, so these are some of the metrics that you can take a look at to see how it's going to perform relative to your diversified portfolio that I am going to assume that you already have. And so what we can see here is that it's going to add a little bit of torque. So now the big question is, should you have an ETF like this in your portfolio? Well, first of all, again, like I said in the disclaimer before, I don't know you, I don't know your portfolio, I don't know your objectives or anything like that. So I can't say definitively for you. However, if you're someone who's picking stocks or picking US stocks and trying to ride a wave of momentum already, I would suspect that a rules-based strategy like this might be a better implementation of what you're trying to do. And it takes a little bit more of the emotion out of the equation because it follows that rules-based strategy. Now, that being said, it's a single factor, single country ETF, and my investing philosophy is more globally diversified. And if we're implementing a factor strategy, I would recommend a multi-factor approach, and that can get pretty complicated. And so if you're a DIY investor trying to start implementing factors, as Fidelity recommends on their own website, use this fund as a small complement to an existing diversified portfolio, so you don't run the risk of over-concentration in your portfolio, regardless of how well it has performed in the very recent past. Fidelity actually offers products that offer globally diversified multi-factor portfolios as well. But if you're interested in something that follows a more traditional market cap index strategy, the asset allocation ETFs from Vanguard and BlackRock are very popular for Canadians and for good reason. And for my breakdown on those ETFs, you can check out this video next.